Welcome to our channel. Today, we're diving into the complexities of understanding Canadian tax residency when moving to the U.S. We'll explore the key considerations, potential scenarios, and steps to ensure you comply with tax obligations. In this video, we will cover the following topics: key considerations you need to be aware of, possible scenarios you might find yourself in, essential steps to consider when relocating, some important advice for making smooth transitions, and finally, a disclaimer to keep in mind. Understanding your residential ties is crucial. We will talk about the significance of your primary residence, social and economic ties, and the importance of your intent and actions in establishing tax residency. First, we talk about the residential ties, such as owning a primary residence in Canada. Even if you don't live there, the CRA may view it as a strong connection. Next, consider social and economic ties. It is essential to sever most of these connections, like family ties, bank accounts, and memberships. Finally, your intentions and actions are crucial. For example, if you aim to primarily reside in the U.S., this should reflect in your decisions, such as your choice of healthcare and financial institutions. Now it's time for a quick quiz question. What is a significant residential tie to Canada when moving to the U.S.? Is it family members in Canada, a primary residence in Canada, bank accounts in Canada, or a Canadian driver's license? You may pause the video now and think about the answer. We will discuss the answer in the next section of the video. The correct answer is a primary residence in Canada. Owning a primary residence is a significant residential tie that can affect your tax residency status even if you're not actively living there. Next, let's consider some possible scenarios you might face based on your ties to Canada. We will look at factual and deemed residency situations. If you maintain significant ties to Canada, you may still be considered a factual resident and, as such, be subject to Canadian tax on your worldwide income. Another scenario is becoming a deemed resident, where the CRA considers you a resident due to substantial residential ties, especially if you own a home in Canada. Now that we understand the scenarios, we will go through some essential steps to consider to ensure you manage your tax obligations responsibly. The first step is to review and sever ties beyond the property, such as closing bank accounts unless needed for property. Secondly, consult with both Canadian and U.S. tax professionals to ensure you have comprehensive advice. Filing a departure tax return may be necessary if you own significant assets when leaving Canada. Finally, ensure you document all changes including healthcare and financial institution activities. Maintaining a Canadian property can complicate your tax situations significantly. Always seek professional guidance to stay compliant with tax obligations in both countries and to minimize any liabilities. Let's summarize what we've learned today. Understanding your residential ties is crucial for tax compliance. Be aware of the potential scenarios you might find yourself classified into, and take proactive steps to manage your ties appropriately. Always enlist expert advice and document everything related to your residency change. It's important to remember that this video provides educational content only and should not be substituted for professional tax advice. Always consult a qualified tax professional for personalized guidance. Thank you for watching our video today. Don't forget to like, share, and subscribe for more insightful content. We would love to hear your thoughts in the comments below.